What if I told you there's a proposed tax that could change how you invest in property in New Zealand? But the real story might not be what the headlines are actually saying. Under the draft proposal, profits from selling investment or commercial property would be taxed at a 28% flat rate. And why does this matter? Well, because first of all, any capital gains made before July 2027 would remain tax-free. And that could represent a significant opportunity, depending on your strategy, of course. I mean, let's look overseas at how the capital gains tax has impacted on those property markets. Australia introduced it in 1985, but house prices surged in the late 1980s. And the UK introduced a capital gains tax in 1965. Yet no long-term market crash followed as a result. And even Canada followed in 1972, and prices rose steadily throughout the next decade. So in all three cases, capital gains tax didn't derail the property market, and property in fact remained a top investment vehicle. And looking at those three locations versus New Zealand property is actually more affordable than any of those countries. So the real driver of prices were in fact not the capital gains tax, but things like interest rates, population growth, and the supply of new dwellings. So let's take a look at the key details of what's proposed in New Zealand, assuming this capital gains tax is introduced. First of all, it's a 28% flat tax. Second, it will only apply to investment and commercial property. Third, any gains made before the 1st of July 2027 would remain tax-free, as they are now. And last of all, investors would need to get their properties valued on the 1st of July or as at the 1st of July 2027 to set the baseline value for that property. What's still really unclear though is whether interest and holding costs will remain as deductible. The current outline says that losses on an investment property after deducting those holding costs and expenses can be offset against future capital gains. So you can't offset that loss against your income or your rental income today, but you can offset it against a future capital gains tax. There is some noise about investors being punished as a result of this capital gains tax, but the facts suggest it's more of a system tidy-up rather than a revolution. The proposal targets future gains only from July 27, not anything earned up until now. And economists predict some short-term behavioural changes though to the property market. Not a substantial shift in values, but there could be a possible bump in sales volumes before July 2027 as some people decide to sell properties prior to the capital gains tax being introduced. But there could also be a likely dip in sales volumes after the introduction date, because based on overseas markets, investors typically, once the capital gains tax is introduced, they tend to hold their properties for longer to make up for that tax that they're going to have to pay on the profit. And they call this the lock-in effect, which may actually stabilise the property market and reduce flipping, as it has in some other countries overseas. And yes, some landlords might try to lift rents to offset future tax, and there's been some commentary around that, but with interest deductibility now restored, the overall effect on yields should actually be minimal. And if you think a capital gains tax is likely to be introduced, the next 18 months actually could offer a rare window to make tax-free gains, but only if you're strategic. I mean, let's say, for example, you purchase a property, a new build in early 2026, and the market lifts by $50,000 by the middle of 2027, not an unrealistic expectation. If the capital gains tax comes in as proposed, that entire gain remains tax-free. After July 27, then any new capital gains would be taxed, but only on the profit beyond that baseline valuation. So to recap, here are the key takeaways. First, capital gains tax is proposed but not confirmed, but we are taking it seriously. If introduced, it would start in July 2027. The family home is exempt, as would be a farm, and any gains prior to the introduction date of July 27 would remain tax-free. Look, the market is likely to adopt and adapt in this respect, not collapse as a result of capital gains tax. At Staircase, we see this as kind of an evolution, not a disruption. And if history repeats, which we expect it will, those who plan ahead and focus on fundamentals will continue to build wealth through property investment. To find out what this might mean for you, go to staircase.co.nz and book your free strategy session with our team today. We'll also have a link in the description below.